They're taking our money,
Yeah.
using it, making millions, billions, trillions, and then they don't give us anything for doing that. So I'm starting to look at banking like, now these need to be my partners. Obviously, they offer me services, but they need to be offering me benefits as well, because I'm the one that's putting the money here, and you're the one that's getting to use it, and you're getting a loan, and you're not really paying much interest. Like, how do we figure this out? And so that was one of those things too, that I realized that it's not going to make you rich by.
Hey, what's going on, guys? Calvin Russell here. Super excited to bring back another guest speaker. Okay, now he's been on this channel before, but you guys have not seen him in quite some time. Okay, now this young man is a financial educator. He's an entrepreneur and a viral content creator. Okay, listen, he's the CEO of The Chosen Agency and a trusted voice on TikTok, Instagram, and of course his YouTube channel. He breaks down debt, real estate, life insurance, and so many other things as well, too, including some banking tips as well. Okay. Now, with nearly 500,000 followers online, he's on a mission to make financial freedom simple and accessible for everyday people. Okay. So listen, get out your notepads. He doesn't have a lot of time. And without any further ado, I want to go ahead and bring on Mr. Chris Cobb. Chris, can you hear me okay?
Yes, sir. What's going on, Calvin?
Doing pretty good, man. How are you?
Man, I'm awesome as always, man. Good to see you. Good to be back, man. It's been a while.
Yes, sir. Yes, sir, man. Listen, I've been seeing you, of course, posting on, social media and everything, and just, man, just making it happen, man. So it's always good to see. I appreciate you being here, man.
Yes, sir, man. I thought I must have pissed you off, man. I was like, man, I hadn't talked to my guy in a while. I was like, what did I do?
No, man,
I was just gonna say, no, I appreciate it. No, seriously, I really do. The platform and get a chance to chat and just catch up with some like-minded people.
That's right, man. That's right. All right, cool. Well, listen, I know you. First off, I want to say thank you, of course, for not only being here, taking away time from your business, your family, and of course, your social media and things of that sort. So listen, I'm not going to hold you up. So I want to get right into it. Okay.
Let's do it.
So, all right. So now you talked about something that I thought a lot of people needed to know about. And that was, how can someone stop paying credit card interest? What's one of the ways that you tell people to stop doing this?
Gotcha. So I'm assuming. Well, so let me give my backstory for all the people that don't know me. So I own an insurance agency. Been doing that for 7 years, and kind of did financial coaching within the agency. And then a lot of people say, "Hey, Chris, I like this information that you're giving. Could you make it more public?" So recently started creating content, creating courses and stuff to give away to people so they can get the information. Because one thing I'm learning, that generational wealth, it doesn't start with assets. It starts with education. That's one thing I've learned. You can have all the money in the world. Look at the Vanderbilts. He's worth $200 billion, passed away within 2 or 3 generations. I don't want to say all gone, but they squandered a lot of it. So it starts with education, learning the right stuff. So fast forward to this guy's, somebody who's studied business, got a degree from UGA, University of Georgia, and eventually started the business, started making pretty good money during COVID, saved over $100,000. And then boom, within a year and a half, I'm back $100,000 in credit card debt. So one of those stories of like never having money, finally made it out, figured things out, and blew the bag. And I didn't buy like cars, clothes, and stuff like that. It was just more or less like bad business deals and just not being wise. So I went from that to having over 6 figures in credit card debt in like 2021, 22-ish, somewhere around there. And that's when I said I'm really going to learn the ins and outs of like personal finance and everything. And so one thing I came across was this thing called a balance transfer. So basically the way the balance transfer works is, if you have credit card debt, there's a lot of credit cards who are still soliciting you, and they're saying, hey, you can move your debt to us. And if you do that, yes, you're going to pay a fee, 3%, 5%. But what we'll do for you is we'll give you 12 months, 15 months, 18 months, maybe 2 years of 0% interest while you're over here. And so what happened was, I started moving some of my credit card debt to different companies. And let's just say you got $10,000 and you paid 3%. That's $300. So that's the fee that you have to pay up front to do this. But now you may have a year to 18 months to pay back the $10,000 with 0% interest. So think about that. If your credit card, I know I'm talking a lot of math, but most credit cards is like 20%. So if you have $10,000 in credit card debt, you're paying like $200 a month in interest, whether you know it or not. So just by taking that first little fee, the first little fee of 3%, rolling it over, now you give yourself 12 to 18 months to figure things out. And even if you can't pay back the maximum amount, you're cutting down the debt without having to pay any interest. And this is what I would do. Once I got towards the end of the credit card balance transfer, if I wasn't completely paid off then because my credit score went up because my debt went down, I was getting out of credit card debt, I would roll it back over to another credit card and get another balance transfer. So I did that for like a year and a half to 2 years, and I was able to pay off over $100,000 in credit card debt. So obviously that wasn't the only thing. Like I had to get serious in business, had to, start making some more money. But during that whole time, I was basically paying back my credit cards without having to pay any interest, a fee here and there. And it's just one of those things that's education that people don't even know exists. And once they see it, they're like, oh, that makes all the sense in the world. I just didn't even know I could do that.
But no, I was saying, man, that's amazing because some people may be saying to themselves, okay, we talk about balance transfers, all the time, but there are always somebody, right, Chris, that's never heard of a balance transfer credit card, and for you to have $100,000 worth of credit card debt, and then to not only have that, but then to qualify for a balance transfer credit cards along the way to pay that down, guys, that's huge. Okay, so again, if you haven't heard of a balance transfer credit card, listen, you most definitely want to do some research on. We also have a video on this on our YouTube channel as well. Okay,
yeah.
But listen,
and one thing I want to add, it's really good for planning because what it's going to be like. You can literally say, okay, I have $10,000 and I have 12 months to pay it off. So just doing the math, that's $800 a month. So now I have to pay $800 a month to pay this off by the end of 12 months. But even if you can't do $800 a month, if you say, let's do 400, now in 12 months, we're going to have half the credit card down. Right. And I think that was it for me. It's just like I had a plan that I could trust finally. And once I had that, and like just moving and putting everything in motion was actually a lot easier. It's just that when you shoot from the hip, it's like, man, I don't know, robbing Peter, paying Paul, this and that. And so that's the most important thing too. The interest, but also creating the plan that you can like stay consistent and you see the light at the end of the tunnel.
That's right. Absolutely, man. Absolutely. Well, listen, there's another thing I want to talk to you about as well, too. Let's go into talking about some banks. Okay. You talked about there are the 3 of the worst banks to keep your money in 2025. I saw that. I was like, man, listen, some people need this perspective, on this. What are those 3 worst banks?
So the 3 worst ones are probably the 3 most popular ones. Chase, which is they're good for like credit cards and businesses, but as far as like just keeping your money in a checking account, not the best. Bank of America, which again is like one of the more popular banks, and the third one is Wells Fargo, which is super popular. And so this is the reason why. One is when you put your money in the bank, they're using your money, which is okay. Like we're okay with that. The problem is, just like we were talking about credit cards, they lend a credit card out to someone. Well, basically, they're lending your money that you put in your checking account. They're saying, hey, Chris, you put in 10,000. I'm going to lend it to Calvin, and I'm going to charge Calvin 20% for it. But what we're going to do is we're going to give you less than 1% for using your money. So that's the thing about those banks, because they're so big, a lot of times they're not partners with the people that are actually putting money into the account. They're basically, I won't say monopolizing, but they're taking our money, using it, making millions, billions, trillions, and then they don't give us anything for doing that. So again, it's like, okay, I'm starting to look at banking like, now these need to be my partners. Obviously, they offer me services, but they need to be offering me benefits as well, because I'm the one that's putting the money here, and you're the one that's getting to use it, and you're getting a loan, and you're not really paying much interest. Like, how do we figure this out? And so that was one of those things too, that I realized that it's not going to make you rich by who you switch and who you bank with, but it could make you $300, $400, $500 every year just having your money sitting in a different place. So it's like, why not doing it? Just not doing work, like just literally sitting somewhere else differently. That's all you got to do.
That's it. And I like how you broke that down, because again, when you think about it, people have their money somewhere, and it makes sense for it to be in the best place possible, where it's either growing or being reinvested or something else, versus just going by. I like to call them drive-by banks, not because you can drive by, but anyway. But but there's a lot of these banks that's out, even online banks. Again, that it's just a better place, to have your money. Now, is this some things that you kind of talk to your clients about, as well as when you talk to them about like life insurance and things of that sort too?
Yeah, absolutely. So that's why I started the financial coaching, because like life insurance is very early on, but there's so many like fundamental things that need to be done before we get to that point. So one of the first things is, yes, we're looking at budgeting, just seeing what's coming in and what's going out. And then one of the second things is we're setting up high yield savings accounts with our clients, because one of the first steps I say is to have a month to 2 months of savings, which is like an emergency fund. And obviously the goal is to have 3 to 6 months, but for now, let's just make sure that we got a couple $1,000s sitting somewhere. So whenever the car breaks down.
Real quick, be sure to download our free ebook today. All you got to do is scan this QR code right here or click the link in the description below. Now back to the video.
Because this thing, anybody who's watching this, I hate to be the bearer of bad news.
Tell them.
The car is going to break down. The refrigerator is going to go out. The washing machine, the hot water heater. The thing is, we don't know which one is going to be every year. But I can assure you, one of these things is going to happen every single year. So now you, as an adult, you can't say, well, I didn't expect this. No, you should. If you ever watch this podcast, you know for a fact you could expect it, because I told you something bad is going to happen, and it's going to cost you $1,000, $1,500 or $2,000, somewhere in between there. So now that we know that, one of the first steps I do is I try to get people to save $2,000, $3,000, $4,000 into a high yield savings account. Yeah, that's our emergency fund. And so that's how we introduce that idea of saying, hey, don't worry about trying to shift your whole life and shift everything you're doing, but let's start having this emergency fund, because one of these things are going to happen. And you know what? If it doesn't happen, that means your money is just going to sit in this bank and it's going to gain interest. So we pray that it don't happen. But if it does, you got it there. You don't have to worry about credit cards or getting loans. And then two, like I said, as long as that money's in there, it's gaining interest. So one of the best groups, I mean, I do this for the culture. One of the best groups, they say this: sunny days, everybody love them, but can you stand the rain? That's what the emergency fund is for. We just want to make sure you can stand the rain when it comes, because it's gonna come. And it's just a simple thing to do. But while you're doing that, your money's making money.
Absolutely. Absolutely. And like you said, the rain's going to come, which is why people buy an umbrella, right? You buy an umbrella because you know it's going to rain one day. And you got to have that same type of financial umbrella, you know? And speaking of which are the best 3 banks? Because you talked about this too. Which are the best 3 places to actually put your money in 2025?
Got you. One place that I like, I love SoFi Bank. And the reason why is just because they're convenient. So for them, the interest that I make right now, I think it's 3.8. So it's not the highest. So for anybody who's looking for the highest, it's not them.
It's better than the other ones.
Oh yeah, absolutely. Because again, like I said, for them, if you put $10,000 in and it's set for the whole year, you're gonna make $380, right? Just doing nothing, just having your money sitting there. If you put $10,000 in Chase, you're gonna make $10, I think. $1, $10, something like that. So it's like, would you rather have 380 or $1? I think everybody knows the answer. So it's much higher. It's 300, 400 times more than you get in a regular bank. The reason I like SoFi, though, is because they are kind of like, SoFi stands for social finance. So they're like the social media banking app. So everything is very simple. The app is like very cool. It's easy to download, easy to get started with. And then two, for anybody who's looking for like affiliate plays or ways to make money, with SoFi, when you sign up, you get a code that every time you refer somebody, you get $75 every time that you refer someone, and they get $25 for signing up. So one thing that I do in my coaching is I'm always trying to show people how to make extra money too. So I'm like, hey, get your high yield savings, but this is how you can make a couple $100 by doing it. Sign yourself up, spouse, best friend, this and that. And so a lot of my students in the first month or so, we make them like $500, $600 by just getting family and friends like situated with that. So that's one thing I like about SoFi. They have that, the referral, and they also have investing. You can get Roth IRAs, you can get crypto, all that type of stuff.
They got Roth IRAs too? I didn't know they had Roth IRAs. Wow.
Yeah, and you can invest in the regular ETFs too, like VOO and all the normal stuff. So that's I just like it because it's convenient. It's very easy.
Yeah.
Okay. I use another one called Forbright, and I think Forbright is like 4.25, 4.5. So it's higher interest. So Forbright, I think it's like 4.25, 4.5, something like that. So it's pretty high. For them, it's not so many benefits. It's not as sexy as far as the app and stuff goes, but it's just higher interest. So a lot of my bills, I just like transfer my money to there every month just to do it. And another place is called Lending Club, again, like 4.5. Lending Club is good for getting personal loans too. So that's the other thing when you bank with some of these people, that sometimes, like obviously the interest in the money that you can make, but two is the relationships, because you just never know. I may need a business loan, this and that. So when you've been with them for quite some time, you've been established, they tend to favor you a little bit more. They trust you a little bit more. So those are
Absolutely.
the three I like. But Capital One is pretty dope.
Yeah.
Discover is pretty dope. I've been seeing a lot about Wealthfront. I haven't like actually done a lot of research, but I've had a lot of people reach out to me and say, "Hey, I love Wealthfront. I've been with them for the past year." And nowadays too, like even Chime, even like PayPal, like all these money holding type.
Yeah, the fintechs. Yeah.
Yeah, a lot of these fintechs, they offer like 4%. So I wouldn't stray away from them either. Like 2 years ago, 3 years ago, I was like, I wouldn't do it. But now most merchants and retailers, they take their account and routing number, and like I said, they're paying competitive interest, and like I said, it's convenience and just ease of use. So
Yeah. Yeah. And you know what? I'm going to circle back to that, to Lending Club. Let me tell y'all something. Don't sleep on Lending Club. Okay. Lending Club does, they have, like he mentioned, they do have, of course, their bank and things of that sort. They also do auto loan refinancing. They do personal loans up to, I think, $50,000 for personal loans. It's a soft pull. So if you guys have been denied from, other people and other places, again, it's another option. It does a soft pull. So again, they do a lot of these types of things. They do a lot of stuff actually, so,
they
but
do.
I know that, yeah, I noticed they just got into, won't say just got into, but it's something they don't promote enough, is they're in the auto refinancing game. So again, that's huge, guys. That's another thing people don't talk about. As you guys know, we talk about that on the channel all the time, how to lower your car payment, things of that sort, get better terms. But again, consider Lending Club. It's a lot of their products are soft pull to get to see the terms. And if you decide to move forward, then of course they'll do that hard pull. Okay. And now, since we're talking about banks, let's transition and talk about, because a lot of people, obviously, you see more banks than you see credit unions, right? But and I'm working on another video. You guys will see it soon. But two things. A lot of these banks have been acquired by credit unions. If you guys have been paying attention, a lot of banks have been acquired by credit unions. Okay. So something to keep your eyes on. That's number one. Okay. And then I think I just forgot number two. I did forget number two, but I'll circle back to it. But either way, credit unions have been buying out a lot of these banks. Let's talk about that, Chris. So now what is your take on banks versus credit unions in general?
Yeah. So most people need to understand that banks are like typically, not always, but typically like public institutions, and they're mainly for profit. I mean, it is what it is. So they're worried about the bottom line. They're trying to figure out how can we make as much money and spend as little as possible. It is what it is. Now, because they do that, that's how they're able to give us mortgages, car loans. They're able to give us credit cards. Like, obviously it's a give and take. So we do benefit from it to some degree. So you have to think about when it comes to banks, it's just business though. So like as far as having a relationship and service, a lot of times it's not there. And so I like big banks just because of the convenience. Like you said, they drive by. Like if you need to pull cash out, if you need to do something, even if you're going to Mexico, you're going to Paris or whatever,
right?
You can still see like Chase or somebody, Wells Fargo. So it's very convenient. So I recommend everybody have a relationship with one of those banks. Even though, like I said, they don't pay you the best, I still recommend everybody have that relationship because you just never know where you are and what you're going to need. And it's so easy to like get in contact with them. So that's that. Now, credit unions, most people don't realize this. A lot of times they're private institutions and they're more like, I don't want to say nonprofit. More like fraternal companies where it's like it's a family. It's almost like a family company. So when you become a member of a credit union, it's like you're part of the group. You're part of the family. And it's so great because when you do that, they offer you more benefits. They offer you more dividends. They say, hey, we profited X amount this quarter. We're going to pay you a percentage of the profits. And so if you want a better relationship, if you want as many benefits as you possibly can, and you want great service, definitely credit union is the way to go. The only thing about it is, like I said, a lot of credit unions are local or relatively local. So if you have a good relationship with this person here, great. But when you're out of town, out of state, out of country, how do you get money? How do you transact? So sometimes that makes it a little bit more difficult. And so again, I tell people, because we live in this dichotomy of like which one, and it's like, no, you can have both. And I recommend people have both. Get that good relationship with the credit union, because again, you're going to get way more deals, benefits from that. But also you want a convenience because you just never know what's going to go in the world. And Chase, those type of banks, man, you call them 24/7, you call them in the middle of the night, whatever. They always got somebody working, something going. So like that's the other thing that I do like about them, that when I have an issue, they're holding it for the most part. Versus the credit unions, a lot of times it could be Monday through Friday. It could be Saturday, we're done at 12, like that type of thing.
Yeah.
So it just depends on what you're looking for. But don't live in a world where you think it's either or when it actually could be both.
Yeah, it actually could be both. And I think that I know a lot of times on my channel, we talk a lot about credit unions a lot. And don't get me wrong, a great relationship to have. But again, let me tell you something. A lot of these banks, they do offer certain different types of products. You can get 0% sometimes, because they can do that, right? Like you said, if you're traveling internationally, things of that sort. But again, different banks have different reasons as to why you should consider them. Let's just say that. You can't be with everybody. Okay.
Correct.
And so that most definitely makes sense, for sure. Then let's talk about this, because obviously everyone's getting, we're getting older now. We got kids now. Some people are now having teens. You mentioned the other day the best banks to consider if you have a teen. What are those banks?
So the two like popular ones are Fidelity and Capital One. So Capital One,
Fidelity, okay.
Yeah. So and what's good about Fidelity is that their checking account is basically a money market.
Yeah.
So it makes on average about 3.9%, close to 4%. Again, not making you rich, but it's them learning to save money. And again, it's something about the adrenaline that you get, the dopamine. When you teach somebody to save something, and then at the end of the year they see they have more than they put in,
man, it's growing.
It's growing. Like it changes you. So that's why I like Fidelity, because they have that. Now, the only thing about Capital One is their interest is not that great. It's like 0.3. It's like typical. But Capital One is just one of those banks that, hey, you want to build that relationship. So because once they turn 18, getting credit cards as well as using the high yield savings that they have for adults is pretty good. Yeah. So we like those two just because of that reason. But there's two like wild card banks that I've been looking into. One is called Crew, CREW, and it's a newer bank. And one thing I like is that it's like family banking. So obviously the parents have to, sign up for the kids, whatever. But what you can do is you can have an app where you all log in and you can kind of monitor them, their spending in their accounts. And it gives you 3.7%. Wow. So it's very dope. It's very tech savvy. I could see them over the next 2-3 years, if they play the cards right, like really making a huge wave, because it's really nice. And it's good for the kids to kind of see how things work and also see the parents. And you can do different things like pay them allowance within the app, chores. You can show them different investment things. So it's just like very useful. A second one is called Step, STEP. And with Step, again, the interest is pretty good. It's like 4%. But one thing I like about them is you can report certain payments that they make to like their credit report, just like you do when you pay rent to an apartment or something like that. So you can work on building your credit while you're under 18. That's another thing that I like with them. So I don't think any of those have any fees, if I'm not mistaken. But Step is something I was looking into just to try to get the kids credit scores up while they're young, unless you got them as an authorized user. Obviously that works, but it just those are things that people could be looking into for their kids that would, one, just help them get set up as far as like their making money, but two, like I said, set them up for the future and having good relationships with good companies.
Yeah, absolutely. No, man, you most definitely set that up, for sure, because, and again, guys, you can always go, obviously, if you have a relationship already with a bank or credit union, something like that. But again, these are some options to consider, because eventually these kids are going to need you for something, and, or even yourself. Like if you're saving for something, let's go ahead and jump into that, because people are, they're trying to save for a house. They're trying to save for a car, or like you said, having money put to the side, when something happens to the car, when the refrigerator goes out. My furnace went out. I was like, oh yeah, that'd be about maybe $2,000 or $3,000. $6,500 later. So I love the furnace now. I ain't like when they hit me with that price tag, but I'm like, man, the house is blasted now. So, but let's talk about that. You talked about the worst way to save money. Okay. I haven't heard anybody talk about this recently, but what is the worst way to save money in your opinion?
Yeah, so we already talked about it a little bit. Just putting it in a regular checking account. That mean, it's because one thing is this: don't get saving and investing confused. So I have a lot of people like, oh, I'm saving into my Roth IRA. And I'm like, no, your investing is things that you're planning to not touch for years. That's different. And can you liquidate your investments? You can. You can do whatever you got to do. Like, it happens. But a lot of times when you're investing in 401ks and stuff like that, there's red tape on how to take money out before retirement age. So you gotta separate the two. And one of the things that I'm focused on right now is teaching people what is savings first, because you want to make sure that you have enough money on hand, cash on hand, that you can take care of your day-to-day expenses and any like typical emergencies. Because at the end of the day, when it comes to investing, the S&P on average does 10%. Some years more, some years less, but on average 10%.
Wow.
Credit cards on average are 22%. So you may be trying to put money in investments, but then if you don't have money saved and you get an emergency, now you're borrowing at 22% and you're making 10%. That's lopsided. That's not good. So you always want to make sure you got enough savings to cover the bases, and then we focus on investing. So that's first things first. Number two is this. When you're talking about saving 2 or 3, 4 months of expenses, most people, I think their household is $3-4 grand a month. So now let's say your household is $3 grand a month. That's what you need to like cover food, rent, all this stuff. If you're saving 3 months of expenses, that means you're saving $9,000, $10,000. And so, like I said, if you put that into Bank of America, Chase, you're getting $1 every year in interest, $10 every year, whatever it is. Versus if you put it into like a high yield savings, you're getting $400, which doesn't seem like a lot, but over the course of 1 year, 2 year, 3 years, and is compounding, now you're talking thousands of dollars, tens of thousands. And by the time you retire, literally hundreds of thousands of dollars that you could have had just by saving your money in a different place. So you want to look at high yield savings. You want to look at maybe short-term CDs, maybe money markets, things like that, where you can put money in, get 4 or 5%. And when you need to liquidate it, you can pull money out without no issues. It doesn't have to be a regular checking account. And you do not want to keep tens of thousands of dollars in your regular checking account, because it's just a waste of money. Inflation grows at 3%. So if you're not making at least 3% on your money, it's wasting away. It's like losing value every day.
Wow.
And so it's just little things like that that you'll see at the end of the year that, again, it won't make you rich. It won't change everything overnight, but over 10, 20, 30 years, because this is the long game that we're playing. We're playing the long game. Obviously, we want to get rich today. We want to make as much as we can today. That's the focus. But also, we want to make sure that we're guaranteeing ourselves that we get rich forever, like when it comes to retirement. And these little things that make it happen. And we just don't see the effects of it that much right now, which is why we don't take it serious. And I think Warren Buffett says the chains of habit are too light to be felt until they're too heavy to be broken. And basically saying like we have these bad habits, and just because you don't get sick today because you didn't work out or you didn't eat well today, you're like, I'll be good. And then it comes to a point where you out of shape, you're in the hospital, you're overweight, you're a couple 100 pounds, and you can't even move. It's like you couldn't feel it as it was happening, and then it got to the point that you can't even unbreak it now. And so, like, we're here to try to get people to understand that start now, as be faithful over few, as little as you can be, and build that habit and continue to build on top of it. And that's what's going to get you where you want to go.
Yeah. Absolutely, man. And you listen, you hit it right on the head, man. You say, listen, a lot of times, again, we don't think it's going to change much. These habits, it plays a major role, for sure, so listen, I'm in Chicago. It's hard to say no to some Doritos, cheese, and meat. Okay. So I know everybody ain't gonna always pick up on that, but man, so either way, it's a difficult thing for me to stay away from. Nachos is my thing. So
I don't think I realized you was in Chicago.
Oh yeah, man, I'm in Chicago. Well, everybody always say the major city, but I'm 30 minutes south of Chicago.
Yeah. What city?
I'm in Matson. So yeah.
Okay, gotcha.
Yeah, I'm in Matson.
One of my friends is from Hammond, Indiana. So
he's 15 minutes away.
Yeah. So I know, I ain't gonna say I know the area, but I know.
Down the street. That's where we go to get our fireworks, because you can't do it in Illinois, but everybody just go to Indiana, buy the fireworks, bring back over.
Yep, that's it.
Anything goes in Indiana. So
So that's how it used to be in Georgia. Like we go to South Carolina to get ours because we have the same.
Ah,
Yeah,
got you. There you go.
yeah,
See, it's always a workaround.
always. Always. I shouldn't say this, but back when we was in college, Alabama would sell alcohol on Sundays. I mean, I know I'm telling myself.
Oh, see, there you go, man. See, now you're going to the college days, man. We
Yeah,
gonna bring it out with
yeah.
There you
That's
go,
what
man.
got me in this mess.
There you go, man. Well, listen, is there any last tip or any last words you want to give to the audience before we wrap up today?
I think I hit it earlier. I said generational wealth is education and assets. And so I think everybody needs to obviously focus on how can you build the businesses, the real estate, and create the assets. That is very important. But two is like really taking time to study this stuff and understand what it is and how it works. Because there's a lot of people who make a ton of money, who build a lot of great things, and they still don't leave anything behind, or it squanders away very, very quickly. And I think for us, like the financial journey is much easier than you think.
Yeah.
It's just that a lot of times we have not been educated on any of it. So it's hard to kind of like navigate it because you have never seen it. But expose yourself, read the books. Don't be afraid. Dive in head first. I know this is like the analogy I always use because my whole family's in education. When a student's behind in the class, they never raise their hand because they don't want to be embarrassed, right? You can't read, can't do the math. And they're like, hey, does everybody get it? They may be sitting in that seat like, nah, I don't get none of this stuff. But instead of asking for help, because they don't want to be embarrassed by their peers, they just say, hey, they just go with the flow. And what happens is you get kids who continue to progress and continue to graduate and move forward, and they never learn basic fundamentals and basic skills. And so now they're in the real world and they can't make it because they don't know what they need to know to make it, to make it in the world. And just because they was afraid to speak up. So that's why I created my school community. That's why I do the financial literacy, because it's more or less trying to give people the opportunity to speak up and say, hey, you said 401k. What is that? You mentioned car insurance, and I heard comprehensive, and I heard deductible, and I heard premium. Ho. What does that mean? So I want people to start raising their hands, asking the questions before they start moving and start, hitting go. And don't let nobody overtalk you. Don't let nobody brush past you. Like literally fight to understand this stuff, because it's very simple. It's not as hard as people make it out to be. But if you don't slow down and say, hey, what does that mean? A lot of times people are not going to tell you, and people prey on people's ignorance. There's a lot of industries that get wealthy off of people's ignorance. So that is why there's a lot of people who are not willing to teach you or talk or slow down, because they know the more you know, the less they make. And this is your future. This is your money. This is your family. It's your responsibility to take care of it. And if somebody's like kind of brushing past you, that's probably not the person you need to be doing business with.
That's right. Absolutely, man. Listen, couldn't have said it any better, man. Well, listen, Chris, we greatly appreciate you stopping by the channel. Make sure you guys go ahead and follow Chris. Listen, he still has room for more followers, okay? On TikTok, Instagram. That's right. TikTok, Instagram, of course, YouTube. And make sure you guys go ahead and keep learning from all of his content that he continues to put out. All right. Thanks again, Chris, man. We appreciate you stopping by today.
Yes, sir, man. I appreciate you having me.
Thanks for watching, and we'll see you guys on the next video.